Hey there, it's always a good day to make money easy, so let's get at it. Today we're going to talk about financial statements, and we're going to start with our baseline accounting equation, assets equaling liabilities plus equity. We're already familiar with that, and so using that familiarity, we're going to build ourselves into a general understanding of our four financial statements and how they fit into our accounting equation. Everything about every financial statement fits inside of this basic house or accounting equation. So let's dive in and take a look. If we separate this equation out into separate houses, our asset house, our liability house, and our equity house, it helps us give a little bit of a better visual as we move forward in looking at the different financial statements that exist. So when we use this mathematically, all of our assets come from either our liabilities, where we borrowed money to obtain our assets, or our equity, where we have our owners owning the assets or having a claim to those assets. So before we get into the actual financial statements, just a quick review on some examples of those categories. In our asset house, we have a bunch of different type of assets, and some of the basic and very commonly occurring assets are going to be our cash. That's our biggest one. And then things like supplies, equipment, receivables, land, that type of stuff. In our liabilities house, we're going to really have all of our payables, short-term payables like accounts payable and salaries payable, and then we build up to longer type payables like notes payable, bonds payable, mortgages, that type of stuff. Inside of our equity house, we're going to have any investments by the owner, depending on what type of company we are. For a sole proprietorship or a partnership, we refer to that as capital. If we are a corporation, we're going to talk about that in terms of stock. And then withdrawals, again, that term is going to be used with sole proprietorships and partnerships. If we're a corporation, we're going to look at dividends instead of withdrawals. It's the same concept, but we're using a different term. And then we have our revenues and expenses inside that equity as well that end up being reflected in a profit or a loss, depending on which is greater, the revenues or the expenses. So going through all that, now we start to look at our financial statements and the storytelling that happens about these three houses and how they work together. And we tell the story in terms of how our company scored for the year, how they did. So it's almost like a score storytelling type of process. And so when we do that, we have four different types of financial statements that we use to tell that story. The first one being the income statement or the profit and loss statement. You'll hear called both things, but the income statement really exists only inside of our equity house, specifically in our revenues and expenses category that makes up a good chunk of our equity. It's definitely our regular day-to-day type of stuff that we see impacting our equity, and so we reflect that in the income statement. The next financial statement that we go ahead and look at sequentially is the statement of our equity itself. So we zoom out a little bit from our profit and loss statement or from our income statement. We zoom out and we look at this house as a whole. How did our income or our loss impact our equity? How did it change our equity? Along with any dividends we may have paid out or stock we may have issued along the way, how did those things change our equity during the accounting period for which we're telling our story? Then we zoom out even further and we look at our balance sheet. Our balance sheet really takes into account the entire asset equals liabilities plus equity or accounting equation. Balance sheet proves the accounting equation correct. It has all of our assets on it, all of our liabilities on it, and all of our equity accounts on it. It does not have our revenues and expenses on it, even though that does operate inside of the equity house. Those accounts are only going to be found on the income statement and then reflected in the equity piece, but not specifically as revenues or expenses on the balance sheet itself. So our balance sheet is a snapshot and a picture as of the last day of the accounting period, whereas our income statement and our statement of equity is a summary of the entire period. That balance sheet is a one-time picture on the very last day. What do we look like at this given moment in time? Then we jump all the way over to our assets section and we zoom in on cash. And that's our final financial statement, is our statement of cash flows. Our statement of cash flows exists only inside of our asset house, and more specifically, only inside of our cash account that is inside of our asset house. It's a very, very, very zoomed in, detailed financial statement looking just at how cash flowed in, how cash flowed out, and what the net results of those flows were. I hope that makes money easy. Catch you next time.